Hi. Welcome to Traders Talk. It's Tuesday again, and this is Ming Hon, your host for Traders Talk. Yeah. All right. So this is Tuesday, and of course, we're here to share with you what has happened in the market and do a bit of training again today. Yeah. So last week we had some trainings, and of course, this week we will also do some trainings on options. So basically the show is actually on trading the stock market, and we are actually focusing on options trading. If this is your first time on this show, great, and great to have you guys on the show. And of course, if you are a visiting um, person to our show, and of course I really appreciate that you guys are sticking to us on this show, because it makes me feel great to be spending the time with you guys, and to also share with you the ins and outs of trading in options, and the benefiting from the stock market. Yeah. So of course today we're going to talk a bit on how the market has actually been doing U-turns. Yeah, U-turns. That means basically the market will actually go up and down and up and down. And of course, for the directional traders, if they get the direction right, then of course that's great for them. But there are a lot of times we also cannot anticipate whether the market is actually going up or whether the market is actually going down. And of course, when we anticipate the market will go up, the thing that the market will always get us is that when we want it to go up, it actually goes down, right? When you want it to go down, then it actually goes up. So of course, it is actually very difficult to predict what will happen in the market, and of course, to avoid having predictions of where the market will go, there are also trading strategies that you will benefit, even though the market does not actually move, or the market does not move. I mean, basically, even if the market is actually trading in a range, you will also be able to actually benefit. Yeah. So this is actually what I wanted to share with you today. Later in the show, after we actually get the market updates. Yeah. So where have we actually been in for the past week? Of course, if you look at what has happened in the market, is that we are actually having a down week last week. And if you look at yesterday itself, S&P has actually gone down by about 1.7%. It gapped down on opening, gapped down I think about 20 over points on opening, and it actually went down further about 70 over points for S&P 500. Yeah, and actually yesterday's close was about 4412. Yeah, 4412. And if you look at Nasdaq itself, in fact, Nasdaq even performed even worse for the past week. Yeah, for the past week. And yesterday itself, it went down about 2.5%. Yeah, of course, this kind of volatility is not something new for us. We have been actually seeing the market do a 1 or 2% down in a day. In fact, in 2 or 3 days, it can also go up by 7 or 8%. So this is the kind of market which we are experiencing right now. And of course, it is actually not a easy task for a lot of traders out there, yeah, to predict where it actually want to go. Okay. Let me just put up the chart so that I can also share with you guys a bit perspective about the market. Just let me share with you this chart. Okay, all right. So, share. So down on the Monday, and of course Tuesday. I hope it will actually go down. I mean, if it is up on a Tuesday, it always comes down if it is up on a Monday, then on Tuesday during our show, it will actually come down. And of course, yesterday it was already down 1%, right? Hopefully, there is actually some recoveries in tonight. Some recoveries tonight. And of course, the S&P futures, right? The S&P futures, I think it is more or less about less than 1 point rate. Yeah, so less than 1 point rate. So is Nasdaq. So basically, the prices right now is actually where it has actually closed yesterday. So it's actually we don't know where the direction is going to go. That's why this show today is actually relevant, because we don't know where the direction is going to go, because it's actually staying just at the so-called opening price or the closing price yesterday. Yeah. So if you look at S&P 500, right? S&P index, right? If you look at this, this is actually the current levels right now. This is the current level here. Okay, actually, last week itself, it is actually very critical for us because the S&P for the past 3 days was actually trading around the range of the 200 moving average. Yeah. So of course, in our newsletter, basically what we told our students was that this is actually a level where it is actually trading within the 200 moving average. And of course, if it managed to actually move above this level, then of course we are more actually bullish for the current week. And of course, if it actually moves down, then the next level which we actually need to be careful or look at is actually the 50 moving average. And of course, if the 50 moving average is actually breached, right, then of course the downside potential would actually be much more. I mean, having said that, I would say that because once it actually goes down, right, here, right, there is, to me, there is actually no real support levels until it actually comes to about this level of about 4150. Yeah, this level. So if it wants to actually go down, then of course the how to say, the market it will actually be very bearish because when it goes, it might the tendency to come down back to this level is actually for me is quite high. So of course for me, I am actually still a bit bullish, but of course I would say I do not want to actually predict the market. So that's why I would actually like to share with you not to predict the market, because if you are predicting the market, let's say for example somewhere in here, right? I mean, when everybody was actually very pessimistic about the market, about the rate hikes which was expected then to happen in March 16, right? Then everybody was actually very bearish. The market actually came down, right? But who knows when the when the war actually happened somewhere in February, right? When the war actually happened in February 25th, instead of further going down because of this tension in the geopolitical tension, right? The market actually rallied on that day itself. Yeah. So of course, like I said, we cannot predict that bad news will cause the market to fall, and good news will cause the market to actually go up. So we also how to say, like I said, we can't predict it. So of course we look at the price action, and of course during that day itself, it was actually a very bullish day. In fact, I don't understand why when they had war, and of course the market actually went up by so much. You see, so of course then it continued to actually rally for the next few days, and when the things were more settled and sanctions and all started to actually come up, there was a bit of volatility and uncertainty where the market will want to go down or go up. Then of course subsequent to that, it has actually crashed just before the week of the interest rate hike. And of course, when the interest rate hike was actually confirmed that there is a 25% basis point increase and not a 50 basis point increase, right? So the market celebrated, and of course we had a huge rally where the S&P and also the Nasdaq also rallied up to quite a high level. That means basically coming back up to the levels where even higher than the levels where it is before the war somewhere in February. Yeah, here it breached the same level here, and of course it went up, hit resistance, and then now coming back to where it was right in February. Yeah, so this level, and of course this level, and of course this level here is actually all at the same level. I would say trading at the so-called same level. So you see all these spots here. We are basically back at square one in end of January. This is actually coming to end of February. And then towards end of March, and now towards mid of April, coming to end of April, we are basically trading within these levels and within a range. You see. So of course, you're talking about what range level. If you can actually pick a broader levels here, right? You can actually see here that within here and here, I would say currently we are within this high and low range, high and low range. Of course, if it moves within this range, and of course if we use a neutral strategies in options trading, right, that's where we can actually capture that we do not care whether the S&P would actually drop down or whether go up. As long as it is trading within a range, we can actually make money within this kind of markets. And of course, if you look at the VIX, right, although the market was actually trading within that range, right? VIX is also trading within range. I think about 18. I think around 18ish to this level here. Sorry, this level here. This level of about 18 to 20 and all the way up to high of 38, and that is where the ups and downs within S&P and VIX shows. You see, when of course the market is at its lows, VIX would actually show at its higher. So that is actually the correlation. When market is coming down or at its low, tendency for VIX to be high. And of course, when market is actually topish, tendency for VIX to actually come down. So right now, VIX is actually trading at the level of about 24, and because of the last week retracement, VIX has actually moved up from slightly below 20 levels back up to 24 at the moment. I think it's still okay. I mean, it is not that high. I would say fear in the market is so. I mean, it's more of uncertainty. But of course, if I say like I said, if it continues to actually drop further below this level, then of course the story on the market fear would actually be different. And when it drops down here, the VIX would probably spike up to above 30 levels once again. And when VIX spikes is of course another opportunity for us as traders, because when VIX spikes, that means that market premium would actually be very rich. That means if you are a option seller, that means if you sell options, right, the market will actually pay you more. Of course, why they pay you more? Because you are actually taking up more risk by selling options. So the market is actually willing to pay you more. And of course, when they pay you more means we actually get to even earn more on credit strategies. Of course, if you are buying options, you are on a directional strategy. If you are trading up or trading down the market, then of course those kind of debit trade options would actually be more expensive. Yeah, and when volatility actually comes down, that will cause an opposite effect to the options pricing. That means if when volatility comes down, right, options will be cheaper, and of course when volatility goes up, then options will be more expensive. Yeah, so depends on which side you are in the trade, or whether you are a buyer or whether you are a seller. You would also take care of volatility to see an IV to see what kind of options value which we are getting, or we are actually paying. Yeah. So this is actually S&P, right? Okay. So coming back to what I actually wanted to share with you, right? Let's come back to the place here. Let me close this. Okay, coming back to actually what I wanted to share with you is actually this great option strategy, which we actually which is actually a non-directional strategy, which we need to actually have and include in our trading arsenal. Yeah, trading arsenal. Okay, so this is actually what we call a neutral strategy. A neutral strategy. Okay, and this neutral strategy, if you guys don't know, is the strategy is actually called iron condor. Yeah. Okay, and iron condor is basically just two vertical spreads, which comprise of a bull put spread, which is actually a credit spread, which is actually bullish in direction, neutral to bullish. Yeah. And of course, the other side of it is actually a bear call spread, which we actually want the price to actually stay the same or come down to actually benefit. So of course, when we have actually two strategy combined, yeah, it will actually become neutral, like positive plus negative plus negative equals. Okay, I'm very bad in this science, so I cannot use that, because I wanted to say if positive positive plus negative equals to neutral. No, it's not. So that's why I say I'm very bad in mathematics. So okay, forget about the example which I actually wanted to say. Okay, so when we mix this together, so basically we want the share price to actually trade within a range. Like just now the S&P, right? What we actually wanted showed you in the S&P, right, is that S&P actually was trading in range for the past 3 months, and if we create an option strategy to actually capture this trading range, right? That means as long as it is trading within this range, we will actually make money. Yeah. So that's why we say this is actually a neutral strategy, and we will benefit from two things. We will benefit from volatility. That means high volatility means that we will actually get more credits for the trades, yeah, for the bull put spread and the bear call spread, which we actually sell. And of course, we will benefit from this what we call a time decay. That means when we keep the trade, right, every day when we actually keep this trade, right, money will actually come into our account. And for every day, money will actually come into our account. But of course, if you are trading a debit trade, right, that means you are paying to buy options, right? Yeah. For every day we should keep the trade, right, the money will actually go out. And of course, if the price don't move, right, let's say you buy a call, right, and if the price don't move towards your direction, that means going up, right, every day you will see the value of your call, right, to actually reduce every day. Even though the price don't change, it will actually come down. Whereas when we actually do this strategy, yeah, credit strategy like iron condors, even if the price don't move every day, the time decay, right, we will actually make money. Yeah, isn't that great? Yeah. So of course, what I also wanted to show you is some back testing, which I've actually got out from the Think or Swim platform, right? Think or Swim platform. And of course, if you guys don't know that Think or Swim platform, you can actually do back testing in that platform. Yeah. If for you guys who is actually interested to learn more how to actually do back testing using the Think or Swim platform, yeah, do put in a note that you are interested in our Facebook page. Then of course I will just guide you to let you know how you actually can do back testing using the Think or Swim platform. So when we actually do a back testing, right, so what I actually did was I actually picked up some stocks here. This is actually a few stocks here. Microsoft. Let me just put this. So this is actually a few stocks here. Microsoft is one. Yep. So let me just do this. oops. Let me do this. Okay. So Microsoft is one. This is Microsoft. Apple. The oops. Okay. Apple. Yeah, you can see that. This is what Goldman Sachs, Visa, and SPY. Yeah, so this is actually five stocks which I actually picked, and what we did was we checked the price on 28th of February, right? So basically, it's just an assumption that on 28th of February, right, you actually did this trade. Yeah, you did this trade on 28th of February. Remember, 28th of February was the time where it was actually about 3 or 4 days after the Ukraine Russia war have actually started, right? The market was actually spiking, and for that, of course, you would found very weird. Why is there a war and then market is going up? And during that time, you also see some uncertainty within the market. We was actually trading. We went up for about 2 days. Then subsequent, it was actually trading sideways for a few days. Yeah. So this was around that time. So for you, it's like, I don't know whether the market is going to go up or whether the market is going to go down. So let's bet on both sides. Okay. So let's bet on both sides. And when we bet on both sides, this is the kind of strategy which we do, which we use an iron condor, which is actually so-called neutral. Yeah. And we do a trade. Let's say Microsoft that time was actually about $298, and then we entered into an iron condor, yeah, which is comprising of a bear call and a bull put, right? Yeah, and we call this iron condor. And when we do iron condor, basically, generally, I would say under high IV environment, preferably the IV for the stocks is at 40. And of course, if you are using platforms like Tastyworks, you can also use IV rank as the so-called premium indicator. And of course, we would actually want to see the IV rank above 20. Yeah, above 20. So that are the conditions for you to actually get more premium. And of course, at what price do you actually enter into the trade? So generally for iron condos, I would say a level of around 20 delta, would be more or less neutral, about around 20 delta. Yeah. So within the platforms which you use, right, you will be able to actually see a column called what is that? A column called delta, right? Delta. So you move all the way to the level where you actually see delta 20, and that is the place where you actually sell the options. Okay. Of course, on the bear call spread, that is the price where you actually sell the options. For example, Microsoft delta 20 during that day was at 320 strike. So you do a trade, sell 320 strike, and then the second thing we should actually do is what is the width of the strike. Yeah. Of course, the width of the strike would actually determine what is your max loss or your buying power for the trade. And in this example, I just took up a $5 width. So I actually did a vertical spread, and I kept the loss at 325. So sell one call 320, buy one call at 325. Okay, and then on the other side, on the put side, is the same. Yeah, move down to delta 20. You will actually get a price of 265. Yeah, on 28th February, 265. And then you actually buy back a put at lower strike. If it is $5 width, then it is actually 260. So bear in mind the width of the strike for the bear call and the bull call is the same for this iron condor. Yes, it is actually the same. And if you actually do this together on as a four-legged strategy, that means you have four options, right? Four options. Here, you actually collect a premium of 168. Of course, generally, I would say the premium which you actually collect for iron condors during normal IV environment. Let's say it's a calm day, and say there is not much volatility in the market, I would say you would actually collect slightly lower premium. And of course, during that time, volatility was high, so the premiums collected is actually also high. Yeah. So this 168 was actually collected on 7th of February. You sold this iron condor, you collected 168. And of course, if you do the same for trades on stocks like Apple, Goldman Sachs, Visa, and SPY, using the same basis, Delta 20 strike, do a vertical bear call spread, and do a vertical bull put spread, you will collect all these kind of premiums on that day. Yeah. So on that day, so for example, how much here? 1, 2, 3, 4, 5. If you do 5 trades, basically you collected 1, 2, 3, 4, 5, 6, 7, 8, $8 or $9 lah. Yeah. So you collected around $8 or $9 here. And basically the range of the expiry date for these iron condors, basically we can actually do between 30 to 45 days. Yeah, 45 days. And we do not want to actually go lower or even further, because the options within 45 days, the what is that? The decay would actually be steepest if 45 days or less. It's because we want the options premium to decay faster, because we are actually on the selling side. Yeah. So then of course, till 8th of April, which is basically about 7 days before expiry, right? This is the prices of all these stocks which we have actually entered. And of course, if you look at Microsoft, we started on 28th of February at $298. On 8th of April, Microsoft was $296. Practically did not move. Yeah. Although the market went up, went down, right? So many times, right? Practically, Microsoft did not move. Then you look at Apple. Okay. On the day we actually did this trade, it was actually 165. And of course, on 8th of April, when we exited this trade, it was actually at 170. Yeah. And then Goldman Sachs was 340. And of course, on 8th of April, it was 321. Yeah. So the Goldman Sachs movement was actually much bigger as compared to these two. Then what about Visa? Okay, Visa 216.12, and then after about close to about 38 days, right? It is 216.98. Practically did not move. What about SPY? SPY was $436, and then on 8th of April, it is $447. Practically did not relatively move. So all these prices, right? If you look at what was the range we are trading, we're actually trading within a range of 320 here, right? Up to here is 265, 320, 265. So this is within range. Apple 175 to 145. Yeah, so this is actually within range. Goldman Sachs 380 to 310. This is actually also within range, but more on the lower range. Yeah. And Visa, we were at 235 and 195. So this is within range. SPY 460 and 398. This was also within range. So all these stocks since 28th February and after about 38 days, market went up, market went down, people panicked. Yeah. And people were happy. It was very bullish, and then we went down also, people also panicked. Yeah. So for this kind of trades which we did, yeah, we don't care whether market goes up or whether it goes down. As long as it trades within range, we make the money. And of course, on the day we actually wanted to exit. So what was the premium? You can buy back at 7 cents, buy back at 45 cents. That means we sold at 168, we buy back at 7 cents. We sold at 157, we bought back at 45 cents. And of course, when we buy back at a lower price, means that we make a profit. For this is 161, for this is 112, for this, because it was actually closer to the lower range, we only make 5 cents for Goldman Sachs. Yeah. And then for Visa, we made 144, and then for SPY, we made 148. And in total, all in for these 5 trades, using this neutral strategy, you collected 570 of profits. Yeah. And of course, what was the max loss, assuming you lose all the trade? Assuming you lose all the trade, your max loss was about 1661. Yeah, max loss was about 1661. And of course, if we compare the returns, that means the profit over the max loss, this is the kind of returns that you actually get for each of the trade. Yeah, 48%, 32%, 1.5%, 42%, and then this is about 46.5%. So to do these 5 trades, basically, you're talking about having a capital of about $2,500. Yeah. And for $2,500, you are making a profit of about $570. Yeah. So this is actually very, I would say, very good kind of returns for $2,500. Yeah. So all in all, about 30%. So this is more or less like the targets which we actually want to achieve for strategies like Iron Condor. Basically, we actually want to achieve a return or a premium of about 30%, yeah, towards the risk which we take, yeah. Okay, so if you look at okay, so if you look at the trade mechanics, right? Okay, I've actually explained just now. We are basically looking at the stock price to actually trade in range, right? To actually trade in range. Yeah, and if you look at the trade mechanics, this is actually the risk profile. If you actually want to go more technical into the risk profile, this is actually how it actually looks like. Yeah, so like just now we are talking about trading within range. So this is actually the range which you actually want the stock to trade. Okay, and when it trades in range, that means this is actually the profit zone where we actually wanted to capture the profits. Of course, the longer you keep the trade, the higher the profits will be. And of course, if you keep the trade until expiry, and if it is within this range, then you actually get the max profit. Yeah. So say for example, the stock price is actually at 114, right? Then of course, when we actually structure this out, you actually do the trade at this kind of what is that, strike prices. Yeah, which we say here is actually a bull put spread. Yeah, bull put spread, and you collect a premium. For this, yeah, on this side, and then you do what is that, bull call, bear call spread. Yeah, this is a bear call spread, and you collect another premium, net premium of this. So in total for this kind of trade, I would say this, you say you collected this 154, and the max loss would be the strike width. Yeah, for example, just now was actually 500, right? So 500 less the credit which you receive for both the vertical spread. Say for in this example, is 154. So this is actually your max loss, which is 500 strike width less total credit received for both the vertical call spread and the vertical put spread. That is your max loss of 345, and your max return would of course be this what is that, the 154, 154, right? 154, yeah, 154 is the max profit. So again, as long as it's trade in range, yeah, you will profit from the trade, profit in the trade, yeah, profit zone. And if course, if it goes outside the break-even price, then it will actually become the loss zone. And of course, break-even price is also very simple to calculate. Just take the short strikes, right? Short strike, if it's on the put side, take the short strike price minus the premium which you receive for the bull put spread. Say for in this example, it is 2 cents, right? So 100 minus 82, that will be your break even on the left side, yeah, which is the put side. And of course, on the call side, which is the short strike, say this is 130 plus the premium which you receive. So that is actually the break-even price. So as long as the stock move within this break-even price, you will actually profit from the trade. Yeah. So this is the neutral strategy, and of course, it will be good for you to actually put this kind of strategy into your trade portfolio. Yeah, so that we don't rely so much into directional trade. Yeah, so it's difficult to predict. As I said, it's difficult to predict where the market is going to go. And of course, like just now was actually neutral, right? The market S&P futures was negative 0.75 when we saw it last, and of course now it's actually +4, +4. Yeah, so this is one time red, one time green. We don't even know where is it going. So this kind of strategy is good as long as it trade in. So next month, let's say now is actually April, right? Today is actually 12th of April, and of course, if the what is that? And of course, if the market in the next 40 days, right, you can actually do this on the May expiry, 20th May expiry. But of course, 20th May expiry, I think it leaves around 38 days, if not mistaken. It's still okay. Yeah, it's still okay. 38 days. And of course, because volatility is currently high, you can actually look at putting up this kind of strategy. But of course, in terms of safety, right? What kind of stocks to choose from? Again, take the criteria: high IV, high IV, high IV, high IV for the stocks. And of course, in terms of the charts, right? You can also look at the charts, where is the price currently being traded. Maybe I will just show you some examples how you actually see how to actually choose what kind of things which basically I personally use, right, to actually see if it is suitable for this kind of strategy. Let me put up. Okay. Share screen. This here. Okay, here. Okay. Oh, so messy. Okay, so let's just say some of the examples which we have actually picked up. Say Microsoft, again coming back to Microsoft, right? Okay, so if you look at Microsoft, like I said earlier, before that, it was actually when we did that was actually in February, right? It was actually trading in range, right? So now, as I said, it's more or less at the same price it was in February. Okay, so potentially, of course, it can again trade in range. And of course, this was the lower range here at 270, and of course, here is actually the higher range of 315, and the current price now is more or less in the middle. Yeah. So of course, if you look at the options chain, right? Options chain, then see when you actually see the options chain, look for delta 20. Where is delta 20 sitting? Delta 20 sitting on the put side, and where is delta 20 sitting on the call side. And if you sell the puts and the calls on that delta 20 and do a strike below for the put and a strike above for the call, it can be $3, it can be $5, but generally I would trade between $3 to $5, nothing lower than those kind of risk. Yeah. And of course, you can actually do that. And of course, you can see what kind of premiums you get. Basically, as I said, we target to actually get the ratio of premium towards the risk of about 30%. Yeah, that means for every 30 cents, your max loss should be 90 cents, right? 90 cents. Yeah. Okay. So that's how you look at it. I mean, this is Microsoft, and of course, you look at Apple, right? Hey? Apple, yeah. Apple is also like I said, is more like in the middle here, right? Okay. Of course, in the middle is slightly lower, lah. Yeah. So of course, Apple, anything here would actually be a great support if you can actually get a pricing on the low side of between 150, and of course the high side of about 180 to about 182, below 185. You can actually get to structure out an iron condor. That would also be possible for you to gain if at the end of 30 or 40 45 days, right, if Apple price stays within the range, yeah. And of course, for more serious traders, uh, even though the strike price move move below the range, of course there are also strategies for you to actually make trade repairs. And of course I won't want to cover during this, because that will be more technical and would actually involve how to say, more explanations and rationale how you actually repair trades, yeah. And for credit what is that, for credit options traders, that's the great thing is that we can actually always repair trades. Yeah, we can always repair trades so that we can actually turn losing trades into winning trades. Yeah, so that was actually what I showed you last week, right? How I actually converted a losing trade on a cash secured put on Twitter, right, to into a winning trade by doing trade repairs. Yeah. If you have not seen how I actually did trade repairs on a cash secured put, right? Revisit the last week's Traders Talk, revisit on our Facebook page. All the 40 over weeks of Traders Talks, which Traders Talk which we have are actually recorded on our Facebook page, and you can actually visit any one of them, because each of the week's content which we air, we would basically share with you some form of insights about trading, or even technical trading trainings like what we have today. Yeah, what we have today. So for those of you who have actually the first time learning about this and getting some insights on what I've actually shown you, give me a thumbs up so that I know that I have actually delivered something beneficial to you guys today. Yeah. Okay, the other thing, of course, the other thing I actually wanted to share with you was just maybe some again market perspective, and how a lot of the market moves really happens into market moves really happen. Say, let me, am I on share screen? Okay, so let me put this. So last week I was actually sharing with you, right? Last week I was actually sharing with you this. If you go to Finviz maps, right? If you go to Finviz, finviz.com, and if you actually move to maps, right, you can actually see what we call a heat map. A heat map. And of course, this heat map is also something for you to actually get a perspective what is actually really happening in the market. Yeah, very useful. What is actually happening in the market. For example, what happened in yesterday? If I actually want to know what happened in the market yesterday, what was down, what was up, I actually go to finviz.com heat map market performance, 1 day performance, which was actually yesterday's performance, and you can actually get to see S&P 500 here, S&P 500, right? This is S&P 500, and this was all the stocks in S&P 500, and you can actually see the bigger box means that it's actually how big it is in S&P 500. Like you see Apple being the biggest, right? Apple, Microsoft, Google, Amazon, and Tesla, these are the big boys. So all the big boys was in red yesterday. All the big boys was in red yesterday. And who were the winners yesterday? And of course, if you look here, generally I would say the whole market was actually down yesterday. I mean, you can see small pockets of greens here, but generally most of it was down. And if you followed our last week Traders Talk, right, what I did mention was the market actually, how to say, depending on the two sectors, the main sectors is that some of the sectors, if it's actually down, right, like on the tech and communication sector, when it is actually down, right, there are certain sectors which will actually be up, and last week I did mention that the sectors which are actually up during that time was actually on the healthcare and the consumer defensive. Okay, because when everybody is panicking, when everybody is selling on tech, mainly on inflation fear, interest rate hikes, inverted yield curves. Yeah, because tech would be more sensitive to all these kind of things, right? So tech was actually selling down last week, right? And those sectors which was actually shooting up was healthcare and consumer defensive. And healthcare shot up to the roof. I think the stock which I mentioned was UNH, right? UNH last week. And I was saying UNH was actually going up very high. And of course, um, um, it really shot, I think, about how much 20 30, at least 30 of 30 over dollars last week. Just last week itself, it has actually gone up by 30 over dollars. And of course, right now, the yesterday was the first day where I saw the there was actually coming on the pullback. In fact, I was actually looking out for a pullback on the healthcare last week, but the market continued to how to say, the market continued to actually go down. The QQQ was practically down the whole week. The tech was actually practically down the whole week. So people were continuing to take safe haven in the defensive stocks, which was the healthcare and the consumer defensive. I mean, stocks like Walmart, Costco, I think yesterday it also went down, but last week it was generally up. Uh, um, Dollar General was also one of the stocks which shot up a lot. Very strong momentum up was also Dollar General DLTR. Yeah, so these were the more or less all the defensive stocks. I mean, stocks like McDonald's and all. Are also defensive. So these are the stocks which people want to actually get safe haven, and move theirs and sell down on the tech side. Yeah. So of course, things will always reverse. I mean, they are just moving around. Yeah. So of course, when you start to see this going up, that means the tech side going up, then of course probability of the defensive and also the that means the healthcare or consumer defensive will actually go down. Yeah. So again, what is going to happen in the next week's earnings is actually coming. If you are actually doing trades, be mindful about the earning date of the trades you enter. Yeah. So if it falls within your time period, either you do not enter into the trade, or you actually exit from the trade before the earnings. Yeah. And of course, why we actually do that is because we these are all what we call binary events, right? Binary events means that when the earnings comes, right, we do not know whether whether the uh, whether the stock will shoot up or shoot down, because we do not know, right? So if you are in the trade and if you are caught within that time, right, of course, from a profit you can actually also become a loss trade. Yeah. All right. So if you have any questions, you can post on the chat box on the Facebook page, and of course, I would be glad to actually answer any of those questions. Otherwise, do always visit our Facebook page and post questions there, or even email us. I mean, we receive a lot of viewers emails. I mean, questions which we also try to help out, because I mean, trading is of course not something you can actually learn in a day. Even for myself, it is actually a continuous learning thing for me. And of course, some things we actually also learn through making mistakes. And of course, making mistakes is something very painful, because when you make mistakes in trading, right, that's the time where you need to actually pay the tuition fees. How to say, uh lose money lah. Of course, we actually want to avoid that. And of course, if we can actually help you get perspective, or clarify uncertainties or doubts which you have, I mean, if you can actually help, we would be most happy to actually show you or actually guide you to the right path. Yeah. All right, so that's all for us this week, and hopefully we will see you guys again next week, and of course again after you have actually learned what we have actually shown you today of market neutral strategies. After this, you do not care whether the market will actually go up or go down, right? I mean, whether it goes up or whether it goes down, you are not so bothered. Yeah, you can actually sleep more comfortably. Yeah, having learned market neutral strategies that we have actually shown you. Yeah, so catch up with you next week, and all the best trading the markets. Okay, bye bye.